serial bonds and term bonds. Fortunately, most governments use serial bonds because their CFOs are scared of using the term bonds. And I'll explain to you why, okay? Serial bonds, what happens with serial bonds? You make equal payments every year, right? There are different varieties of serial bond. There is a serial bond where the payment is deferred, the first payment to a later period. A little trick by the CFO to avoid making the first payment. They defer it to a later time. But mostly they work by you amortizing it equally over the life of the bond. So the first year, you borrow $1 million. It's over 10 years. You pay what? $100,000, and interest is at 5%. $100,000 of principal and $50,000 of interest. What's the next year? $100,000 of principal and 5% of $900,000, because now you only have $900,000. $45,000 of interest. Do you see how it goes? So what happens? Your interest keeps on declining, right? That's your serial bond, and that's it. There's nothing more to it than that. Now we come to the more complicated variety, which is the term bond. Term bond works a little differently. Basically what they say is that what we're going to do is we will give you the interest every year, but not the principal. And you say, wait a minute, we want our principal. So you'll get the principal at the end of the 10 years. And you'll get it all, which is what? At the end of year 10, you'll get what? $1 million with the last interest payment. Got it? So what do? Does the town just say, oh, let's have fun for 9 years, and the 10th year we'll try to figure out where we get the $1 million from? No, what they do is each year they put into something called a sinking fund. Has anybody heard of this term? A sinking fund is a fund where monies are deposited so that at the end of a period, they will be available for you to use. Okay? You don't take it out. So this is what happens. So we've got a really smart CFO. He says, you know what? I've got a great idea. This is what I'm going to do. Instead of making a payment of $100,000 every year, I'm going to put in $95,000. And you say, but we need $100,000. He says, no, I'll put the $95,000 and I'm going to make money on that $95,000. I'm going to make lots of it. So it's like putting $100,000, that's what I have. So basically what they do is, you know this concept of future value, right? Learned that present value, future value, okay. So basically what you're trying to do is you're trying to come up with a rate of return where you make a series of equal payments into a sinking fund. So at the end, those payments with interest will equal $1 million. That's called future value of an annuity. If there's anything, you always make sure, like the back of your hand, there are 4 things you should never, as accountants, never forget to use. Concept of present value and present value of an annuity, future value and future value of annuity. So if I said to you, okay, at the age of 67, I'd like to have a nest egg of $5 million. My rate of return is 7%. I have another 40 years to go. What should be my deposit each year? You should be able to calculate that very quickly by using the future value of an annuity, except in this case you'd be dividing by the factor. And same thing with the present value. You just won the lottery. The state comes in and says, you know, every year we'll give you $500,000. Or you can take this number today. Well, what would you do? You take those future payments and calculate the present value of an annuity based on the interest rate that you feel comfortable with. And then you can figure out, okay, you know, these guys, if I take the money now, that's a whole lot more than taking the money later. Now, obviously, I haven't taken into account tax considerations, but this is how we use, and unfortunately, a lot of accountants don't understand these concepts. You really need to know this like the back of your hand. This concept of using present and future value to be able to do this, because that's what it's really finance is based on. So here we have the serial bonds. Advantages of serial bonds: they're self-amortizing, no sinking fund needed. Okay. Let me see. These are the term bonds. I think I explained to you this. They require a sinking fund and somebody who really knows what they're doing. Because if you deposit a certain amount and you are assuming a rate of return of 10% and you get only 5%, are you going to have your $1 million at the end? No. You're going to be in trouble. And that's why, fortunately, many public entities don't use this. Because it's scary. A couple of items on understanding accounting principles and procedures for debt using modified accrual basis. Budgetary accounting, you don't have to use budget. You know what the principal and interest is going to be each year, okay? Term bonds, sinking funds reported at fair value. You have to show that because now you're investing. And by the way, in investments, as we'll see in Chapter 9, government securities are required to